What's up everybody? Welcome to Zeppe Invest. I hope you have a magnificent day. Leave a like, hit that subscribe button and let's begin with the topic of today is 5 REITs to buy in 2020. First things first, what is a REIT? A REIT is a real investment trust. It's actually a company owning and typically operating in the real estate which generates income. Most REITs are specialized in a specific real estate sector, focusing their time, energy and funding on that particular segment of the entire real estate horizon. To officially qualify as a real investment trust, you have to invest at least 75% of its total assets in real estate, receive at least 75% of its gross income from real property rents, and return a minimum of 90% of its taxable income into a form of shareholder dividend each year. My first pick of this list is VTR, Ventus Inc. S&P 500 company is a leading real estate investment trust. It diversifies portfolio approximately in 1,200 different assets in the United States, Canada, and the United Kingdom, consisting of senior housing communities and medical office buildings. So this we can place in the healthcare sector, so it's a healthcare REIT. The company is founded in 1983. Let's take a close look to the chart. We can see in the last 5 years they are down with 18%. In the last 12 months they are also down with 7%, so they're in a downtrend. They have a market cap of 22 billion. The funds from operation is 3.84. The P/FFO is 15.25. That is something like a PE ratio for a REIT, and the funds from operation is like an EPS for a REIT. The current yield is 5.42%, so that is very big in my opinion. So let's take a close look to the dividend. In the last 18 years, for every year they have increased the dividend. The adjusted funds for operations, that is something like a payout ratio, but then for a REIT, is currently sitting at 82%. The 5-year yield on cost is 4.62% and the 10-year CAGR is 5.85%. My second pick for this list is CCI, Crown Castle International Corp. Crown Castle owns, operates and leases more than 40,000 cell towers and has more than 75,000 routes of miles of fiber supporting small cells and fiber solution across every major US market. This communication infrastructure is very huge, so we call this a 5G REIT stock. They have 5,000 employees and are founded in 1994. Let's take a look to the chart. We can see in the last 5 years, this company has an amazing run-up with over 90%. In the last 12 months, they had a run-up of over 40%. The market cap is currently sitting at 62 billion. The funds from operations, so the EPS for a REIT is 5.74. The PFFO is sitting at 26. And they pay a dividend of 3.19%. That's pretty good in my opinion. So let's take a deeper look to that dividend. They have increased that dividends for every year in the last 5 years, so not a very big history, but the adjusted funds from operations is 83%, so this is kinda okay. The 5-year yield on cost is 5.9%, and then the 3-year CAGR is 8.27%. But personally, I do not like to look at a 3-year span of the CAGR, but I like to see it from a 10-year span. A little bit more convenient. My third company on this list is LTC Properties. It invests in senior housing and healthcare properties, primarily through sale-leasebacks and mortgage financing. LTC holds more than 200 investments in 28 states with 30 operating partners. The portfolio is comprised of approximately 50% senior housing and 50% skilled nursing properties. We can qualify this as a healthcare REIT. It's founded in 1992. If we jump into the chart, we can see they have not grown a lot in the last 5 years, only 5%, in the last 12 months also 5%. So this is also the smallest company I've shown to you. They have a market cap of 1.8 billion. The funds from operations, so again the EPS is 2.98, the PFFO is 15.7, they pay a yield of 4.87, so that's pretty nice, that's almost 5%. But if you take a closer look to the dividends, we can see that they did not grow their dividends for like 4 years. The last update was in 2016 around October-ish. The adjustment funds from operations is 76%, so it's one of the lowest of all the companies I've shown so far. The 5-year yield on cost is 4.77%. The 10-year growth of the CAGR is 3.87%. In the beginning, I was doubting to show you this company because it's a very small one. But again, you always have to do your small research. I just try to entertain you with some new companies. The next pick is one of my favorites, MPW, Medical Property Trusts. Medical Property Trusts is a self-advised real estate investment trust formed to acquire and develop net leased hospital facilities. They are operating in the United States, Italy, Germany, the UK, and Spain. They are founded in 2003. Now let's take a look to the chart. We can see that in the last 5 years this company has very good growth with 50%. In the last 12 months they grown 25%. The market cap is not very big, not very small, it's 11.5 billion. The funds from operation are 1.31. The P/FFO is 17. And the yield is 4.63%. They pay a very high yield, and the PFFO is kinda okay for me. The dividends, in the last 7 years, they have steadily increased that dividends. The adjusted funds from operation is currently sitting at 79%. The 5-year yield on cost is just under 7%. And the 10-year CAGR is sitting at 2.46%. This due, they have cut the dividend in 2008 when the recession occurred. Now you can think, is this a bad sign? Again, do your own research, but personally, I think that they were a very young company. They have a lot of more experience, a lot more cash on hand right now, so I think they would survive the next recession. Let's go, baby. Who is ready for the last pick? Of course, it's Realty Income. I saved this company for the last because it's the most known and everybody put it in his top 5 REIT list because it is just one of the best out there. It's the monthly dividend company. They have a cash flow from over 5,900 real estate properties. They owned under long-term lease agreement with commercial tenants. So it's a retail REIT. It's founded in 1969. So let's take a look to the interesting stuff. On the 5-year chart, we can see they have grown with 40%. And the last 12 months they have grown with 18%. They have a market cap of 25 billion. The funds from operations, so the EPS is 3.27, that is pretty great. The P/FFO is 23.66, so I do have to say this is a little bit to the higher side, but the nice part is they pay a dividend of 3.60%. So let's take a deeper look to that juicy dividend. They have steadily increased that dividend every year for the last 26 years, so pretty amazing history. They have an adjusted funds from operations of 85%, so pretty high, but it's still okay for a REIT. The 5-year yield on cost is 5.29%, and the compound annual growth rate over 10 years is 4.75%. This is huge. So personally, of all the 5 companies we've discussed, I own Realty Income. I have currently 9 shares and my buy-in price was $74. So I was at the late side, but I'm still pretty young and this company is going to be for the very long term. I'm talking about 10, 15, 20 years. So, did you like the video? Please hit that like button, it really helps me out in growing this channel and my goal is to grow this channel. So If you like the video, hit that subscribe button, like it, share it with all your friends, and thank you very much. I'm out. Peace.